You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the Extreme Retirement Solutions Series. And on today's show, Nominal versus Real Returns with special guest, top and core to the table, Curtis Cloke, creator of the Annuity Bulldozer.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, the creator of the Annuity Bulldozer, and especially in the second half, I'm going to call him the commotion guy. Hey, Curtis Cloke. Hey, Curtis, how you doing?
Good.
Well, we're talking, if you missed yesterday's show, I need you to hop out to www.thebiz.tv and watch it. It's kind of our introduction platform. I talked a lot about his resume, some of the things that he's doing. And this is great because this is a person that has real life stories from retail clients and huge on the scene, MDRT, top of the table, production, and speaks all over in NAF and all our other industries. And of course, is now one of the contributing, I call it professorial, I forgot how to say that name, but just that kind of guy with the American College. You're really one of the facilitators of this new retirement certification.
Correct. Retirement income certified professional.
Now, when we talked about this yesterday, and everybody loves, Bill Gross, and actually they call him Mr. Pimco, right? Listen to this quote because I think it's kind of unique. It says, this is Bill talking. He says, "We will never revert to the mean. There is a near certain probability that the financial-based global economy of the past half-century will not return." Curtis, what does that mean?
Well, there are three reasons that Bill gives for that. The first one is increased taxation. And with the information that we shared in the show last week, we talked about the charts that we see about entitlements, Social Security, Medicare, and so forth. The second one is increased volatility. And listen, we have smart guys today from MIT graduates who are building algorithms that know how to do a strike price in a way that we've never been able to do it before. And we're undermining daily profits at a level that we've never been able to do. And a number of reasons that exist in the market today that didn't exist 5, even 10 years ago, the volatility is going to be a different thing. The buy and hold strategies won't hold true. And then, of course, with the high debt of not just domestic, but the high debt of global, we're going to see lower growth rates being manipulated by the governments for a long time to come.
I'm looking at this whole issue of nominal and real returns. And you have a gentleman, this Dutch mathematician. Talk a little bit about this guy. Who is this guy and why do we care?
All right. Well, Daniel Bernoulli was a Dutch polymath in 1738. And what he did, in my view, was he gave the world a gift. Now, the gift hasn't meant a whole lot, except that let me just tell you what the gift is. He created a formula that in English language says this: expected value equals the odds of gain times the value of gain. And not many know how to calculate it. And so if you think of a dice, just a single dice, the odds of gain, what's the chance of rolling a 6 on that dice? Well, 1 in 6. What's the chance of rolling a 3? Well, 1 in 6. In fact, it's 1 in 6 no matter what number you roll in the die. However, how many times actuarially do you have to roll the die for that to be true? The answer, 10 million times. In other words, to have a predictable outcome of this formula, you have to have a law of large numbers. And when it comes to retirement income planning and all these moving parts, including longevity risk, we're going to enter into products that guarantee the outcome, but because they incorporate a law of large numbers.
When I think about the probability of having a successful retirement, which is really what we're talking about, bottom line, give me a little definition, nominal versus real returns, and why this definition is redrawing the retirement map.
Well, I like to refer to Thornburg Investment Real Return Study. And so you can Google this. Thornburg Investment Real Return. They have a beautiful white paper. Now, they put this out each August, and they're reporting on December 31 of the prior year. So we won't see the 2012 ending values until sometime in August. But let me just share with you the statistics about the returns for 2011. So if we go back to 1981, that's 30 years of historical performance. If we just take the measure of the S&P 500. The S&P 500 from 1981 to December 31st of 2011 generated 10.98% average nominal return. What Thornburg says is you can't buy the S&P direct as a retail investor. You have to go through a conduit. So they plugged in a 50 basis point fee drag. And they interpolated 50 basis point fee drag. Then they interpolated taxes for capital gains and dividends on non-qualified money based upon a 28% tax bracket. Then they interpolated a 3% level of inflation. And when you take all those fee drags, all those expenses associated with that, what the real return is for a nominal return of 1098 is about 5.78. Now, if you look, they've been doing this about 10, 11 years. If you look over time, somewhere between 4 and 5.5, 5.7, that's about where it is. And virtually all of the studies show somewhere in the 10 to 11 range for the purposes of the S&P as a nominal return. What I realized when I started looking at efficiencies is whatever helped me eliminate fee drag, whatever helped me eliminate the inflation effect of the income distribution model, and whatever helped me mitigate taxes. I wasn't starting at a nominal spot, I was starting at a pure return spot. And so I'm considering guaranteed insurance products that distribute income that create those three basic efficiencies.
How revolutionary is this? I mean, we know it from we never had a position to explain ourselves. How do I talk about this? How revolutionary is this for people to grab a hold of, this difference between nominal returns and real returns?
Well, it's amazing because so many times people are first of all, they're plugging into these retirement software systems wrong information. They're not counting the fact that they're paying a broker some sort of a fee. They're not counting the fact that there are taxes and have no way of interpolating inflation.
Wow. And
so it's very important that they understand the difference between pure and nominal returns.
Well, you know, last year we were supposed to impose the new 408B2 compliance that describes every fee, administration, bureaucratic, the IRA fees, the expense fees, and they still didn't put in the SAI fees. Oh my goodness, now we're calculating all this as a drag on returns. When we come back, we're going to talk more about nominal and real returns with Curtis Cloke. And remember, we're going to talk a little bit about emotion commotion. Oh, I love that. You don't forget to jump out to IULUniversity.com for the best training and education on life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Curtis Cloke. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the backroom technician icon right on the Biz blog for their 30-day free trial offer for the best needs analysis education material for nearly every single financial planning scenario. And on today's show, Curtis is offering a free 30-day trial offer on the Annuity Bulldozer. It's called download.annuitybulldozer.com. Just put that URL into your browser and pull it up, and you'll get 30 days free to try all the. This is such cool stuff, I got to tell you. And just remember, a heads up before moving forward with anything you hear on our show, always consult your tax advisor and legal counsel, as well as your broker-dealer compliance officer if you're FINRA licensed. We're talking about this emotion commotion, but before we tell you why it's emotion commotion, we have to kind of tell you some statistics. I understand beta. I actually get it. Risk. I understand risk. But this whole thing we're going to talk about here when we talk about returns has a lot to do with the quest for alpha. Talk a little bit about that and let's walk right through it.
Well, you know, in our last segment we talked about the difference between nominal returns and what Thornburg calls real returns. But that's based upon perfect behavior. That meant that whole 30 years that you put all your money there in just one sector and you stayed the course no matter how ugly it got and no matter how close you were to the end. Well, the reality is that's just not the way people live. That's not the way advisors advise. I mean, we're diversifying and we're changing over time, and people have emotions over time. Well, there's two studies that we focus on that say, look, it's not as good as what the real return study provides, because, first of all, there was a Morningstar report that said out of 17 fund categories, look, the nominal returns of these average categories is somewhere between 3 and 2%. And the more noted study is the Dalbar study that was a 20-year study that ended in December of 2010. And they said, look, if you took a 50-50 mix of the S&P and the U.S. long bonds, represented by the 50-50 mix, 9.1 and 6.9 respectively were the returns of those two 50-50 blends. But average investor experience on the nominal return was 3.8 and 1. In other words, if you composite that out, the average investor experience was 2.6. You build in fee drag, you build in taxes, and a 3% inflation. That's a negative performance number that client actually received. And so the message there is what we call the emotion commotion. People buy when they shouldn't buy, they sell when they shouldn't sell, and we've all seen these subliminal fear, subliminal greed charts out there.
When I'm thinking of how this is why we're looking at our product lines. I mean, it sounds like, Steve, you're so proprietary, you're talking about insurance products, but I'm trying to eliminate the fee drag. I'm trying to eliminate the inflation possibility. I'm trying to eliminate, or at least mitigate as much as possible, the tax issues. And those are being incorporated in these studies you're bringing out, which really reduces our actual number. And when I'm looking at these returns, I mean, this is somewhat frightening because, I'm thinking, well, the S&P did 10% for the last 30 years. But maybe no. Not in real numbers, not in the power of purchase dollars.
Right. Then you couple that with the fact that in retirement it looks very different than in accumulation, because now we have sequence of returns that you have to couple into there, and sequence of returns with volatility and distribution. So now those numbers, though they're not being reflected in the Thornburg study that I mentioned a moment ago, that's pure accumulation. Couple that with sequence of returns risk and all the things that go very differently in distribution, and now you understand the complexity of average returns in retirement for distribution. The point here is to understand what the likelihood of earning pure returns are, what's the level of pure returns, and what kind of rates of return do clients perceive they have to chase in order to have success. And so once you understand this, when we get to additional segments of your show, what you're going to find is how these so apply to what it is that we're going to talk about for optimizing Social Security with all the efficiencies.
Well, see, this blows my mind, because if we're talking about returns and people are chasing returns, that means I have to up my beta risk to get those returns. And if I put my portfolio in exposure, and I'm thinking about what you just said, which is I had an accumulation period, now we're talking about overlaying the distribution, the sequence issue. I'm like, what would have happened if you were talking about accumulations during the lost decade, 2001 to 2011, and then I put that, because we lost 4 years out of that year. But then if I said, what would happen if I would have been taking distributions during that 10-year period?
Oh, it would have been terrifically tragic. We have a software calculator that we just created real briefly that we use in our own shop that basically says, look, if you were in the S&P and you just simply distributed a 4% distribution rate, what that looked like in 10 years. And if you did it with a 3% inflation, what it looked like in 10 years. And the bottom line is a return of 5%, would have been substantially better, obviously, than general markets in that period. We call it, the Prudential has something called the retirement red zone. We like to call it the danger zone. But one of the things that you need to think about is, how do I block money for a future stream of income for which I can lock and load the pure returns, as well as have the distribution without all that risk of sequence of returns and chasing the wrong rates and so forth and so on. And so we'll talk about that.
Well, I'm just trying to think about seniors now approaching retirement. They think, wow, after they hear their advisor say, I need 3% for my inflation, I have tax issues. Oh, and by the way, I'm still charging a fee. On top of all that, I have to sit there and say, as a senior man, I can't take the exposure to get those numbers. I'm caught in the middle of the vortex, apparently, between what my advisor is telling me and what my reality check is telling me.
Well, I think the whole conversation is around what do clients want. Today, with all the things that we've experienced with the lost decade, they basically are looking for having an income floor of guarantees. And just understand, unless we're willing to have a conversation about an insurance product There are no guarantees. Stocks don't guarantee, bonds don't guarantee, real estate or investment trusts, they don't guarantee. The only way we're going to be able to have a legitimate conversation about the word guarantee is as long as we're in an insurance product.
Well, that's our show for today. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz.tv. That's the buzz on the biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.